Cash conversion cycle is the number of days it takes to convert inventory and other assets into cash. And I want to use the example of a sporting goods manufacturer that's selling goods to retailers as a way to explain this concept. There's three components to the concept. So the first is days inventory outstanding. In other words, how long does it take you to convert and sell inventory? So the formula is average inventory divided by cost of sales times 365. We're going to assume we're looking at this over a year, so everything's getting multiplied by a number of days of 365. Average inventory, cost of sales, 365. So it turns out with that formula that it's about 46 days. So it takes you 46 days on average to sell inventory that you own. So that's the first part, that's inventory. We add to that days sales outstanding, and this is about accounts receivable. How long does it take you on average to collect receivables and convert them into cash? So what you can see here so far is one component is converting and selling inventory and getting that back in cash, and the other one is collecting receivables, getting that in cash. This is all about converting assets into cash. So the formula here is accounts receivable divided by net credit sales. Net credit sales means sales where you don't get paid immediately in cash, and we also deduct discounts and other items out of the sale number. So it's the net amount that we're going to receive, no returns, no discounts, that gets removed from a sale that was not immediately paid in cash. So the formula is accounts receivable divided by net credit sales times 365, and that number is 91 days. So the first number for inventory is 46 plus the 91. Then we subtract the last number, which is average days payable outstanding, because this is about money going out the door. The first two were about money coming in the door. So the formula is average accounts payable divided by cost of sales times 365. How long does it take on average for you to pay your vendors and suppliers? Paying your vendors and suppliers. So this is money going out the door. So that number happens to be 68. So if we take the first two, 46 plus 91 days, and we subtract the days payable, 68, well, we end up with 69 days. What that means is the cash conversion cycle, the time it takes to convert cash invested in these assets back into cash that we get in the door from a sale, is 69 days. So that's how the cycle works.